Copper, bold, hold, fold, or who cares? It's not gold. The price of copper has been on a tear. There's an expectation in the markets that the big copper mines in Chile, Peru will be shutting down to the virus. Combine that with the market's belief that the government of China will stimulate their economy and thus buy all the copper they can get their hands on. And the belief is that the strong run in copper prices will continue. What you're looking at right now is a chart that shows China's monthly imports of copper. The trend is your friend, it's moving up. We've received a lot of feedback on our long-term stance on commodities, base metals, and precious metals, especially when it comes to my positive swap line versus negative swap line nations thesis. And the biggest counter argument that we've received from management teams, analysts, and investors is that, hey, Marin, the market has already priced in the geopolitical risk. Wrong. We've gone through hundreds of examples where analysts are using the same discount rates for projects in both high-risk emerging market nations as well as politically stable jurisdictions. And that's across all the different stages of the project's lifecycle, from production, development, and exploration stage assets for the precious and base metal commodities. We can also give many examples where the market is valuing peer comparable assets more highly in risky jurisdictions compared to similar projects in the US, Australia, or Canada based off of the management teams in place. My point is, in my career, I've never seen the market pundits, and investors so complacent to the geopolitical risks with their investments. There's a mantra of go where the gold, silver, copper, oil is, and has firmly set hold in the resource sector. But the risks aren't being discounted correctly in the valuation models. Now, I'm going to say a little personal. There's some well-known gurus who've said, well, Marin's a pretty smart guy and he knows what he's talking about, but they've made all their money in risky jurisdictions and, they don't like places like Canada or the US. The market has changed and the old timers aren't changing their perceptions. Let's take a look at the recent spike in copper and share prices. Global and especially Chinese economic activity took a nosedive in Q1 2020. That was one of the main drivers behind plummeting copper prices. As expected, the drop in share prices of copper miners was magnified. China's swift post-coronavirus economic recovery and the resumption of industrial activity has led to a strong price movement higher in copper and other industrial metals. The chart that you're looking at right now is taking Q1 into account. The returns of North American copper producer has been less than stellar on a year-to-date basis. However, Chinese industrial demand has begun to tick up. Look no further than the Chinese domestic steel production, which is the chart you're looking at now, is at all-time highs. Looking at the North American copper miner returns since March 23rd, 2020 lows, we see that they far outpace the returns on not only copper itself, but also the major US and Canadian equity indices. The copper miner's return of about 108% return in 4 months is hard to overlook. In fact, this is 30.5% greater than the return on the New York Stock Exchange ARCA Gold Miners Index. Copper's commodity sentiment. In the futures market for high-grade copper cathode, we can see exactly how bullish speculator sentiment has become. In the last 15 weeks, the number of spec long positions increased by 111%, or specifically 47,000 contracts, while the price of copper has increased about 27%. Conversely, the spec short positions have fallen by about 31%, or 21,000 contracts during the same period of time. The reason why non-commercial, or what we call spec positions, are more closely examined as a sentiment indicator is because commercial traders, for example, copper producers and their exposed counterparties, usually take the short side of the trade because their primary goal is to hedge their production for risk management. Speculators, on the other hand, have little interest in hedging and want to make money by betting on the commodity prices. If copper continues to catch a tailwind, you can bet that desperate countries with budget shortfalls will look to return to the people what's rightfully theirs. We will redistribute mineral wealth to the people. You can see that tagline that'll make it happen. So You can see how the implications for positive swap line nations versus negative swap line nations is enormous in the years to come, and you must prepare your portfolio accordingly. Governments will feel the deflationary pressures in their local economies and significant unrest from their people. There will be pressure to put their citizens first, and redistributing the mineral wealth to the people will happen in many parts of the world. Here's a chart which shows the exposure of selected major commodities production to regions without US swap lines, that's in red, compared to regions with US swap line exposure. We've covered from iron ore to silver, gold, oil, copper, palladium, and uranium. What I'm saying is the more red, the more risk. The chart has a lot of information in one picture. As you can see, 72% of the world's copper production come from regions without US swap lines in place. I do believe that this becomes a focal issue as the world grows and the less developed economies continue to electrify. Currently, Peru and Chile don't have US swap lines, but the two produce roughly 40%, about 17.6 billion pounds of the world's copper every year. Both governments are right-leaning currently and pro-mining development and international development. But we've seen video footage of union mining meetings at very large mines in both Peru and Chile that suggest there are some serious issues at the mine sites there. I wouldn't be surprised to see the current government parties lose in their federal elections in Peru and Chile in 2021. Both are having a federal election in 2021. Some interesting developments are in the future. Taking this a step further, the top 50 copper mines produce 28.6 billion pounds of copper annually, which is about 64% of annual global copper production. Now, non-swap line or negative swap line countries produce 22 billion pounds of that copper, compared to positive swap line regions, which produce a paltry 6.6 billion pounds. This is a dicey situation, to say the least. The risk of increased taxes to outright nationalization of large mines is real and could happen. Let's drill down further and examine each major copper producer's exposure to swap versus non-swap line regions. In the next chart, you'll see the amount of red in each company's production bar is significant. There really isn't a safe place to put capital to work in any of the top copper producers. Freeport, the least exposed senior producer to negative swap lines, is very interesting, and a company that Barrick CEO Mark Bristow has said many times he would consider a merger with. It owns the Grasberg deposit in Indonesia, which is an enormous copper gold deposit. Grasberg is no doubt a world-class operation. It just comes down to whether the Indonesians are now willing to play ball or if they'll revert back to their same nationalist approach with their oil and gas assets. In the past, the government has already once forced its way to increase ownership of the mine. Even though it's been stated that Indonesia has been granted swap lines from the US Fed, Indonesia isn't listed in the official US Fed documents we track that get updated weekly. Thus, from all the government documentation we've seen thus far, no funds have actually been lent to the Central Bank of Indonesia from the US Fed via swap lines yet. Now, a lot of people want to know what my Catoosa's copper outlook is. I've no doubt that there's much potential for serious economic headwinds, which could slow global growth and subsequently copper demand in the near term. Yet, copper prices and copper-focused equity share prices remain strong. The long-term thesis for copper is very bullish, and the outlook remains bullish. Just to be clear, I am bullish on copper too. I'm just cautious with regards to the potential risks still present in the current macro global economy and the high valuations many base metal producers are already receiving from the market. We recently put together an alert on a brand new copper company, which many Catoosa subscribers received as a dividend from an existing company at no cost base. On its first day, the spinout was valued at a 500% premium to our subscribers' cost base from its spinout valuation. The company was up as much as 149% out of the gates from its previous financing price. This isn't new or rare for members of Catoosa's resource opportunities. In fact, it's the second set of free shares my subscribers and I have received from a previous deal, along with free trading warrants. You can minimize your risk and amplify your upside when markets work in your favor. If you don't have the time to spot what companies can offer this in the resource sector, don't worry. Consider becoming a subscriber to the KRO, and you'll be able to follow exactly what I'm doing. Now, P.S. Gold is knocking on the door of all-time highs. Behind the scenes, I'm working to bring one of the hottest gold deals to my subscribers, while I'll be personally writing a large check, and my subscribers will be able to get invested at the same round as insiders. And the best part is, you won't have to be a accredited investor to get involved in this. Once it's published, you will want to make sure you're in the room to get in the deal. And there's only one way to get access to the information. It's to be a subscriber to the KRO.